Financial ratios are essential tools for understanding and analyzing company financial health. In this video, you'll learn about three critical metrics: the price-to-earnings ratio, the price-to-book ratio, and the debt-to-equity ratio. These ratios help investors make informed decisions by revealing important insights about valuation, profitability, and risk. Financial ratios are mathematical relationships between different items found in a company's financial statements. They provide a standardized way to evaluate company performance and health. Ratios allow you to compare companies across different industries and sizes, making apples-to-apples comparisons possible. You can track performance trends over time to see if a company is improving or declining. Most importantly, these ratios help assess three key areas: valuation, which tells you if a stock is fairly priced; profitability, which shows how well a company generates earnings; and risk, which reveals potential financial vulnerabilities. The price-to-earnings ratio, commonly abbreviated as P/E ratio, is one of the most widely used valuation metrics. The formula is straightforward. Divide the market price per share by the earnings per share, or EPS essentially. This ratio measures how much investors are willing to pay for each dollar of earnings the company generates. For example, if a stock has a P/E ratio of 20, it means investors are paying $20 for every $1 of annual earnings. Understanding what a P/E ratio tells you is crucial for investment decisions. A high P/E ratio can mean two things. Either the stock is overvalued and trading at an expensive price, or investors have high expectations for future growth and are willing to pay a premium. Conversely, a low P/E ratio might indicate that the stock is undervalued and represents a good buying opportunity, or it could signal that the company faces challenges and investors are skeptical. Context is everything when interpreting P/E ratios. Always compare a company's P/E ratio to others in the same industry, because different sectors have different normal ranges. Also, analyze how the ratio changes over time to spot trends and patterns. The price-to-book ratio, or P/B ratio, compares a company's market value to its accounting value. The formula divides the market price per share by the book value per share. Book value represents the company's net asset value as recorded on the balance sheet. It's calculated by taking total assets minus total liabilities. This ratio essentially tells you how much the market values the company compared to what the company's assets are worth on paper. The P/B ratio provides valuable insights into valuation. When the P/B ratio is less than 1, the stock is trading below its book value. This could mean the stock is undervalued and presents a buying opportunity, or the company might have poor future prospects that justify the discount. When the P/B ratio is greater than 1, the stock trades above book value. This typically happens when the market expects strong future growth, or the company has valuable intangible assets like brand value or patents that aren't fully captured on the balance sheet. The P/B ratio works best for analyzing asset-heavy industries such as banks, manufacturing companies, and real estate firms, where tangible assets make up a significant portion of the business. The debt-to-equity ratio, often written as D/E or D/E ratio, measures a company's financial leverage. The formula is simple: divide total debt by total equity. This ratio reveals how much debt a company uses to finance its operations compared to equity from shareholders. It's a critical indicator of financial risk and shows whether a company can meet its long-term obligations. Understanding the D/E ratio helps assess financial stability. A high debt-to-equity ratio means the company relies heavily on borrowed money to fund operations, which indicates higher financial risk. If the business faces difficulties, it might struggle to repay creditors. A low D/E ratio shows the company uses more equity financing, suggesting lower financial risk and greater stability. However, don't judge ratios in isolation. Always compare against industry standards, because capital-intensive industries like utilities naturally have higher debt levels than technology companies. Remember that balance is key. While too much debt increases risk, a moderate amount of debt can actually boost returns for shareholders without creating excessive danger. It's all about finding the right balance for each specific business and industry.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.